Guys, how's it going? So it's good to have you all on board for the next month. We've got a small group today. A few people haven't paid for the next month yet, but we'll see how we get on. Today we're looking at anticipating volatility, specifically liquidity gaps and compression, as well as a couple of behaviors I don't like to see as price is approaching a level. Okay, so the last webinar before the Q&A, we went over market structure and how to identify areas or prices which present good trading opportunities based on this idea that price moves to the less liquid side of the market. And this week we're going to cover the kind of behaviors I like to see as price moves into a level. So the approach, specifically liquidity gaps and compression, both of which often precede volatility, which is really what we're interested in as traders. Okay. So I'm interested in how price moves into my level and how it moves out of my level. And as I explained in the first week, volatility is a function of liquidity. Price moves up and down as a result of the ratio of market to limit orders at any given price. So it pushes to the less liquid side of the market. In other words, if there's no liquidity, you might think of liquidity as a kind of friction. Price will likely move quite quickly, and this is what I want, for price to move with good momentum. So I'm always watching the way in which price approaches my entry, because how price is behaving as it moves into the level is really just as important as the level itself, and will very often determine whether or not I think the trade is even worth taking. Okay, so let's get on with that. As usual, just jump in if you've got any questions or you want me to clarify something. Okay. Now, what a lot of people will do is they'll have some level, okay, and before taking a trade, they'll wait for price to react to the level. So they'll look for something like a pin bar or golfing candle or some engulfing price action, some sign that price is responding to the level. At which point, you know, the trade has really already been and gone. Price has moved so far away from the level that the risk reward's relatively shit. Price is quite likely already bumping up against some opposing order flow. And this is one of the reasons why people get chopped up. They wait for quote unquote confirmation, which is often just kind of chasing price. And as a result, their stop's way too wide. Okay, they're entering down here, stop up there. And you know, they're effectively entering where they could have been taking first profit, and you know, even moving their stop down or at least taking a risk off the trade. But and instead, they're now watching price move against them because they're basically getting in late. Now, I'll come on to confirmation in the webinar and scale, because it is something I look for in certain situations, but I'm generally looking for something very specific, because my general opinion is that if you understand order flow and recognize what's happening and what kind of price action is likely to increase the probability of the trade working out, you shouldn't be afraid to enter kind of at or close to the level. So with that in mind, what should you be looking for? What is it you're looking for that will give you that confidence to execute at the level? And as I've said before, I don't like trading mechanically, based on kind of categorizing the different ways in which price moves, because I think the emphasis should really be on honing your ability to kind of recognize probabilities and how those probabilities are changing in real time. But that being said, I'm going to do my best to explain just a few different kinds of price action I like to see as price comes into or approaches a level. So basically, the conditions under which I expect volatility, and then it's up to you really to go and find and then internalize those behaviors so that you can then recognize them in real time. Okay, so that you can recognize those behaviors as price is unfolding. So I'm generally watching for a few things when price is approaching an area I'm interested in trading at. And the first is a thin or illiquid move into a level, which more often than not looks something like something like that. Okay, the candle's getting longer. And the premise here, as I've explained, is that price is overextended as a result of the fact that when it's moving like this, it will often start kind of jumping in order to find counterparties. So when the market moves out of balance, the price market will often kind of jump, put in an illiquid move like that, and as a result, it's vulnerable to a retrace. Okay. And I showed you some examples of what this looks like on a tick chart last week or the week before, I think. But in case you need reminding, here it is again. This is a 10 tick chart, just demonstrating how price behaves when it starts kind of reaching for orders, when it's overextended. And there are no candles here. These two lines just represent the bid and the ask, but it's a nice kind of visual of what goes on inside the candle, as it were, when price starts to overshoot. So just notice it's Bitcoin, by the way, down here, the spread, that will be, let's just get this drawn to that. That will be $0.50 spread. And notice that as price starts reaching higher and higher, it gets kind of overextended, and the bid-ask spread starts kind of widening. Okay, as the market has to start jumping in order to find counterparties. So that's what illiquidity looks like. So it's becoming more volatile, right? And that volatility is what we're after. And this is the same move on the candlestick chart. Okay, that's the move I just showed you on that 10 tick chart. And notice again that the higher price moves, the longer the candles get, and the kind of extent or breadth of those moves. This is only a very small time frame chart, but that's not necessarily volume. That is the market having to reach for liquidity in an environment in which liquidity is scarce. And it's that behavior which leaves a liquidity void or vacuum in its wake. So a gap in price, which as I've explained, is quite likely to get filled if price starts trading back into that area. And price kind of consolidates up here, but when buys dry up and or finally get absorbed, price will very often just kind of draw back into that void. And because volatility breeds volatility, in other words, if you have an illiquid move like this, there's a good chance it will move back through that area. You know, it will often draw back just as fast as it came into the level. So as traders, that's what we want to see, a fast move into a level where we expect liquidity, because we've got a situation which repeats, okay, and which we can exploit, and that is, in this case, weakness on the bid side, okay, an illiquid move, a void in liquidity, and a situation where we can exploit it. So, in other words, the presence of liquidity. So, some level up here, where we expect liquidity. Okay. So basically, we get volatility when there's an absence of liquidity, and or when we get a big influx of orders. So what you always have to be asking yourself is, where are these areas? Because you want to be taking trades at areas there's more than likely to be resting liquidity and trading into thin or weak legs in price. Okay. Just to kind of recap, any questions about that so far? Cool. Right. Okay. So I showed you something similar a couple of weeks ago, but I'm just going to show you what this looks like on the cumulative volume delta again, so that you can see how easy it is for the market to completely retrace thin moves like the one I just showed you. So this is just some random price action I plucked from the FUSD chart, I think, and on the bottom again you've got the cumulative volume delta, and this here is the area I want to focus on first. So the market sells off. Quite dramatically, not unexpected, given you've got this low here and likely some low off to the left, okay, which this was responding to, below which you have stop market orders, okay. So it sells off. And notice, the candle's getting longer here, okay. But because it's this is a highly illiquid move, it's weak, in other words, price retraces the entire move in the next candle, okay. It wicks up, and then in the next candle it retraces the entire move, even though in that next candle there was actually more market selling than buying, okay. Okay, it sells off here. That's the delta for that candle. And then in the next candle, a slight negative delta, and the market closes up. So that can only mean one thing, and that is an absence of liquidity on the sell side, a void in price. So just quite a nice kind of visual example of that. And you've got another quite nice example over here. Again, price shits itself, sells off quite rapidly below this low and below these minor lows here. Okay, so it's not unexpected. Again, there's there's way more market selling than there is buying in this candle. It's strong negative delta, and yet you know, you get this pin bar. Price closes more or less up where it opened. Again, as a result of the fact that there are so few sellers in here. Okay, and I know I've showed you this before, but I really want to drill this into your minds because this is the edge. This is why you want to be getting in at the end of thin or illiquid moves like this, because price moves to the less liquid side of the market, and as a result, you're more likely to get a good response, manageable response. So I've just got a few examples here, so you can get a good idea of exactly what I'm looking for. This, I think, is a chart of gold on the M15, and you can see that every time the market kind of extends like it does here, notice the candle's getting longer. Price very quickly comes back and fills in that move. Okay, illiquid move, price immediately comes back and fills that in. Price runs out here, the candles get longer, that's an illiquid move. Price very quickly comes back and fills that in. And you see the same thing just repeating again and again. FUSD, I think, again on the hourly, just so you can see how the same dynamic plays out across all markets. Thin or illiquid move, thin or illiquid move. It's not difficult to spot them. Okay, just these open kind of reaching moves, right? And every time price extends like that, it gets thinner and weaker, and as a result, price has no trouble kind of coming back and filling in these moves, right? This is a cable chart, again, just so that you can see the kind of price action I like to see as price comes into a level. Again, thin move, long candles, price immediately retraces. It's just everywhere. Thin move, price retraces. Excuse me, this is sticking a little bit. But you get the idea, okay? Thin move, price retraces. So that's what we want, because the way in which price responds when the market's moving like that is really quite consistent. You have some idea about how price should move when it starts trading back into that area, as a result of the way in which price moved in the past. So there's no science here. It's just about learning to identify when price is moving in this kind of illiquid manner, and what you want is for it to move like that into a level at which you expect there to be some significant liquidity. Okay, that's the gold. One more for good measure. This is the Bitcoin top. For those of you who trade Bitcoin, you'll remember how bullish people were when price was up in here, up around 13-14k, and in here. But as I explained at the start of this program, it's often when the market looks most bullish that it's actually it's most bearish, because moves like this one here, okay, they are highly illiquid and therefore likely to get filled in quite quickly, whatever the time frame. And so it's precisely this kind of price action that I'll look to fade if the market's running up into a nice level. Now, I should note that there is a difference between that kind of behavior and what I'd call impulsive price action, which actually looks a little bit more like this. And I'll explain what this is in a minute. This is a chart of Euro USD, and again, this is not what I want to see into a level. So, unusually large, wide-ranging candles from a distance, moves which you might consider unusually large or kind of outside of the normal course of a trading day on whatever pair you're trading. And this is important, which break through areas of liquidity where you would normally expect some resistance with apparent ease. Okay, so in this example, you've got some lows here, price breaks those lows. This is an FTR. There's some fresh liquidity in there, okay, but price just kind of blasts through that level. You get a massive move, which is unusually large. It's all in one candle. So if I see something like that, let's say I'm looking to buy, somewhere up in here. If I see price just blasting through levels at which I would expect it to stall or pause or consolidate under kind of normal conditions, and it just blasts through it and puts in a big candle like that, that's not something I'm looking to fade. Okay, that's what I'd call that. That's what I'd call impulsive price action. Alex is asking, but is that not an illiquid move? Yes, you're right. It is an illiquid move. But this indicates something very particular to me, which will make me stay out of it, or at least wait for more price action to develop. The reason being that if it's blasting through levels at which I know there to be liquidity, okay, or there will usually be liquidity pooling at a level like that. Either there's a lot more buying interest than I anticipated, or for whatever reason, sell side liquidity is getting kind of pulled from the market. So, what I want to see is an illiquid move. Well, I think I've got an example on the next slide actually, which should help kind of elucidate. Right, so Euro USD again. Let's say we've got a liquidity gap like this one here. Okay, as a result of that gap, I expect a high momentum move through that area. Okay, I expect price to move quickly through that area because there's no liquidity in here. So, why wouldn't it move through there with relative ease? It's not necessarily indicative of unusual buying pressure. It's just moving quickly because there's an illiquid move here on the left. So in this case, this move is simply a function of liquidity. And so if you've got a nice level, fresh liquidity up there, you want to be taking these because more often than not, you will at least get a reaction here. Again, as a result of the fact that price has moved into the level quickly, there's quite likely an absence of liquidity in here, okay? So it's not difficult for price to retrace. So this means you have time to manage your trade, and if it's no good, you can cut it. And if the price consolidates up here, you can cut the trade because you know how it should be responding here. It should be moving quickly. So you can get the fuck out because price isn't moving as you expected. So under the right circumstances, I want a fast move into the level. What I don't want to see, even though it's also illiquid, is price smashing through resistance on approach. Because, as I say, this suggests either heavy or unusual buying for whatever reason. There are many things you're not aware of when you're trading, and or a lack of sell side liquidity. And under these conditions, it becomes less likely that levels we'd normally expect price to react at will hold. Does that make sense, Alex? Okay. Great. So essentially what I'm looking for is something like, let's see. Okay. Very simple. Okay, something like this is fine. Okay, there's an illiquid move here. Price consumes the liquidity at that level before slipping through, largely on the back of stops before hitting this next area of liquidity. Okay, that's what I want to see. It's not this illiquid move here is not unexpected, as opposed to something like that. Okay. In this scenario, I expect price to stall or react at this level, and so this is what I'd consider impulsive. It's an unusually large move. It's breaking levels at which I'd normally expect a reaction. Although this is an illiquid move, it's indicative of unusual heavy selling, or for whatever reason, and buyers are putting their liquidity. So in that case, that's not something I'd step in front of. I'd always wait for more price action to develop, rather than stepping in at the level like I would in this scenario. Okay, so it's kind of the difference between this here. There's your illiquid move. We expect price to move quickly through that when it starts trading back into that area. So that's not unexpected. Okay, that's an illiquid move, but it's not impulsive. It's not breaking any kind of significant levels, right? It's not unusually large. It's an illiquid move into a fresh or untapped liquidity, and as a result, you get a full retrace there, as opposed to something like this. Okay, a massive move, and price just kind of smashes through all of that buy side liquidity, all of those levels. And this is kind of the same reason I wouldn't recommend leaving limits in before major news. Not particularly relevant for those of you who trade Bitcoin, but for anyone who trades FX. Leading up to an economic report or some key numbers, for example, banks or market makers will remove their orders, so they'll withdraw liquidity from the market. And in the same way, price is therefore quite likely to slice through levels which might otherwise have stopped it. Okay, just to demonstrate, this is Euro USD again. I think a 30-minute chart, and at the time I was trading Euro, and this is the level I wanted to buy at. Okay, high, low. When price breaks this high, this whole structure becomes your FTR. Okay, this is the area from which price left with good momentum, which it broke out of that structure, and it's still fresh or untested. Okay, so it's a nice level. It's a level at which I'd normally expect liquidity to be pooling because it's fresh, hasn't been tested yet. But I can't remember what news it was exactly, but it was on the calendar. So I was well aware of it before this move happened, and just like I passed on this trade, I was looking to buy there, but given the time at which the move occurred on the back of news, I didn't buy there. So just like I passed on this trade because I didn't want to stand in the way of news, large players or entities, banks, market makers, they will also have been repositioning themselves here. So imagine for a minute that under normal conditions, you'd have some liquidity pooling up here at whatever structure on the left is kind of constraining this flag. Maybe you'd have a little bit of residual liquidity down at these lows, and some down in this fresh level here. Okay. Before major news events, all of this liquidity that gets pooled, so liquidity moves away from the market because traders are expecting or anticipating and protecting themselves against volatility. So it's almost a kind of self-fulfilling kind of price dynamic. People pool liquidity because they want to protect themselves against volatility, and as a result, you get volatility. So the liquidity closer to market gets withdrawn, and the liquidity starts pooling further away from the market. So down in this level here. Does that make sense? And as a result, price just blasts through this level and responds at the next liquidity base. Alex is asking, in this example, couldn't you just say that it was a valid reaction to the lower level? Why wouldn't you buy that level and only the top one? Yeah, you could buy that level, yeah, but the idea is, you don't really know how large this move is going to be. Well, I don't anyway, because I don't have the the kind of intellectual tools to be able to interpret the significance of news in the FX market. So I don't know how big this move is going to be. So for sure, this is also a nice level, but generally when there's news, I'm just waiting for price to find some support or resistance. Okay, I'm not buying a level blind because you're going to get an impulsive move which could be much larger than you expected. And if the news is really bad, let's say you buy here and your stop's there. If the news is really bad, anyone with liquidity down here, that's all going to get pulled, and as a result, you're going to get massive slippage. That's right. Yeah, there's no way to know how big it is, unless you're in the position to be able to interpret the significance of news. So yeah, to be a good price action trader, you have to be aware of news events, because they're going to have a big impact on the trading environment. And yeah, unless you're in a position to judge the significance of news events, then I just recommend steering clear of news altogether, at least until price settles down. And I guess by news, I don't just mean news. As I explained in the first webinar, price action can almost take on a significance of its own, such that an unusually large or high momentum move can almost take on the character of news. I'm not sure if that makes sense, but I'll try and explain. So, a move like this one here is almost a kind of event in itself. It's similar to a news event in that it will cause people to withdraw liquidity from the market. A move like that will cause people to withdraw liquidity from the market, fueling or exaggerating the move down. Because just like you don't want to get run over, and so what happens is that liquidity moves away from the market. So what I'm explaining here is relevant not just for FX traders who need to be aware of news, but if you trade Bitcoin and what I want to get across is that price action events can take on a similar character. Okay, an extreme move can kind of distort the normal in trading environment. Anyway, that's just a kind of side note. So be careful trading news, because we expect volatility. Watch out for price action events, because although a move like that does tend to be illiquid, they can often move much further than you might otherwise expect. Okay, is that all clear? Great. So while I'm talking about what I don't want to see ahead of a level, i.e. news or impulsive price action, I'll just go over basing, because as I've explained, one of the areas in which we can anticipate volatility is on the break of some significant structure, simply because these areas are likely to attract an influx of order flow. So this is what I mean by basing. Okay, just some consolidation, a range ahead of a level. Let's say I'm wanting to sell, I don't know, up in here somewhere. Okay, let's say I'm wanting to sell up in there. This consolidation ahead of the level is not what I want to see. Because as I've explained, these highs here and here and up in here, they are points of reference or triggers for action, whether forced or unforced, and so it's often quite likely that when that consolidation breaks to the upside, the influx of order flow you often get on a breakout like that, largely comprised of stop losses, will often be significant enough to drive price straight through whatever liquidity there might have been at your level. Okay, again, up at the top here, let's say you wanted to buy up at this high. Okay, price consolidates ahead of the level, and then when that consolidation breaks, price just blasts straight through that level. So consolidation represents positioning. you'll have long positioning and short positioning in these areas, and yeah, when price breaks out of these ranges, yeah, the break of those highs represent, as I say, triggers for action. So either stops or breakout buys, and that order flow, that breakout order flow, is often going to be strong enough to push price through the liquidity at whatever level you had marked out. So that's something to watch out for, and it's one of the times I look for confirmation rather than entering at the level itself. But that's something I'll leave until the webinar on scale, because it will take some explaining. Got a question from Alex. What about if there is some inherent trend within the consolidation, i.e. a descending triangle structure? I'm not entirely sure what the question is. Do you mean, are you asking, does it depend on what kind of shape this structure takes? Not particularly, no. I mean, say it's looking weak below the level. Okay, it does depend. I'm going to leave it until the, like lower highs into support. I'm going to leave that explanation until the webinar on false breaks. Okay, but okay, because I don't want to get too confusing. But generally speaking, if there is basing ahead of a level, I will wait for some kind of confirmation before trading that. Okay, because otherwise you run the risk of the breakout order flow pushing straight through your level, whatever kind of structure that takes. So even if it's a kind of descending triangle, okay, support's looking weak. When price breaks out of this structure, these highs are going to act as triggers for action. Okay, so whatever shape the structure takes, be wary of basing or consolidation just ahead of a level, unless you have some very specific conditions, which I'll come on to in a few weeks' time. Okay. Another thing to note is that these areas of volume or consolidation represent potential sticking points for price. Okay, so if you're fading a breakout like this one, the what you might call the first trouble area is just far too close. Okay, you've got potential support there, and so there's just no value in the trade. What you want is room for price to run. Okay, as I keep saying, it all comes back to whether or not price has space to move, and so you really don't want to be shorting almost directly into an area which could be potential support. You want to be trading at areas where you expect price to move in your favor with relative ease. In other words, thin or weak legs in price, or areas in which liquidity is likely quite scarce. So things I don't want to see: consolidation or basing kind of directly ahead of or too close to the level, major news events, and price action which I would consider impulsive. things I do like to see: thin or weak leg in price. Price kind of drifting up into the level of illiquid move. Candles getting longer. And the second thing I like to see is compression. And compression is something you're probably all familiar with in one form or another. It will often come in the form of a pattern. So a falling wedge like this one here, for example, is a form of compression. I think this is some price action from XRP, BTC, and what's happening here is each time price moves down, notice that it's retracing and consuming the sell side liquidity, which is moving down with price. So imagine there are pockets of liquidity up in these highs. Okay, liquidity is kind of moving down with price. Each time price comes back up and tests those highs, it's consuming those orders. So the clusters of supply at those levels are being at least partially eroded or consumed by those retests. So in this case, you can kind of imagine resistance as being a dynamic thing. Okay, it's not just a level. You can see that resistance is moving lower and lower. Okay, that's where the liquidity is. Sell limits moving down with price. As a result, you get this kind of wedge type structure. But each time price sells off, it comes back and retests that sell side liquidity, that resistance. Does that make sense? So that's compression, and as a result, price has no trouble moving through that area when it eventually finds buyers. So you can almost think of this area as a void or vacuum in price, because as a result of the way in which price traded through this area, okay, you get like 9-10 retests here. There's likely very little liquidity in there. So compression is one of the things I like to see as price approaches my level, because the question I'm always asking is, well, what would prevent price from moving in my favor if I were to take a trade, let's say, down here? It's not the best example because you've got this kind of errant wick, but let's say, you want it to long here. Well, what would prevent price from moving in my favor? Well, there's really nothing much here. As a result of the way in which price traded here, it's quite likely consumed the majority of sell side liquidity, which was moving down with price. Okay, the only thing which is going to prevent price from rising is sell limits, and so what we're looking for is for those to have been already consumed by the time we enter a trade. Because if there are sellers kind of lurking just above our entry, an obstacle or something which is going to prevent price from moving in our favor, then it's no good. There's no value in the trade. And so it really pays to recognize what the consumption of liquidity looks like on a chart. And it's compression. And really the same kind of mechanism is at work in lots of classical charting patterns. Like bull flags, triangles, okay, as I say, these kind of wedge type structures. Okay. As the range in which price is trading in gets tighter and tighter in these examples, price is consuming the liquidity. Let's take this example here in the middle. Price will have found resistance at some level here. Those sell limits, some of them start kind of moving down with price, but as price kind of trades through this area, all of that liquidity gets depleted. So as price trades in this range, it's kind of eating up the liquidity which is keeping price contained, and as a result, price will usually break out quite violently. So here's an example of a kind of symmetrical triangle on cable, and you can see that the area above price here is totally compressed. Okay, that's all totally compressed, and even off to the left here. Okay, that high is a test of that. That's a test of that. That's a test of that. That's a test of that. Okay, so the next fresh liquidity is all the way up in here. And you see that's where price finds resistance. Okay, so this whole area, okay, that's all compression. Okay, there's very likely little liquidity in there, and you can see as a result, price moves through there quite violently. And of course, you've also got stops building above those highs as well. You'll have stops up here, which will fuel the move up. And as I explained in the first week, the speed at which price usually moves here will also have momentum traders jumping in and market makers pulling their liquidity. So same dynamics again and again. We can expect volatility when there is little or no liquidity. Okay, in this case, you haven't got a gap or a void, but you have got the consumption of liquidity in the form of compression, and or when we get a big influx of orders. Okay, and this is one of those areas: compression, consumption of liquidity, a build-up of stops. Okay, so you know you're likely to get an influx of orders there, and so it's just about finding these areas, and compression is one of them. That being said, I don't particularly like trading structures like this one here, because as you can see, price is kind of compressed on both sides here, and so it it could quite easily have just broken either way here. There's also no clear level, so ideally what I want to see is something more like this. Okay, there's your liquidity, and prices rising or falling if you're looking to buy, and as it moves up, prices coming back and consuming all of the residual liquidity. Okay, so see price runs out of this level, leaves this fresh liquidity, comes back and tests it. Okay, the same here, runs out of this level, comes back and tests it, until price finally reaches some fresh sell side liquidity, and at this point, that's the last available buy side liquidity. It's exhausted here. Okay, there's likely very little sell side liquidity in this area, and you've got a fresh level here. Okay, and as a result, price kind of slices through that area. So it's kind of almost kind of clearing the way, as it were, for a nice move down. And there are a couple of ways you can trade this kind of price action, but first I just want to make it clear that not all wedges are compression, not all triangles or bull or bear flags are compression. It's really not about the pattern, it's about the order flow dynamics which are shaping the pattern. So for example, I see people drawing out these kind of wedge type structures or triangles, and they'll mark them out like that or like that. But very often you'll see that there's still untested liquidity somewhere up in these structures. And so you have to remember it's not about the pattern, it's about assessing whether or not the liquidity at these levels has actually been consumed. And so when you're marking out compression, watch out for areas of liquidity which haven't actually been tested, because these levels explain why you'll often get sorry, let's draw this out. Okay, fake outs like that, so-called fake outs. Okay, people will draw kind of structures like this out. They'll short on a break, but they are, I guess, unaware of the fact that there is still untested liquidity somewhere in that structure. So watch out for that, because that kind of explains why price will often appear to break out these structures and then just suddenly reverse. And people will blame it on manipulation, but it's just the same thing again and again. And this is when I just plucked from SBTC, I think, on MEX, but you see this all the time. Again, you've got some, people will have had some kind of, I don't know how you draw it out, some kind of triangle structure marked out. And lo and behold, price breaks out. Let me draw this a bit clearer. Okay, that's better. Lo and behold, price breaks out because, well, this area is totally compressed. Okay, see, that's a test of that. That's a test of that. You can see all these wicks in here. That's the consumption of liquidity. Right, so price is totally compressed up until here, and above that you've got a liquidity void. So it's no surprise that price has no trouble moving through the area, but there is still fresh liquidity up in here, and the same in here, in fact. Okay. Notice how those areas were never really tested, and as a result, price quickly reverses and stops everyone out. So this is just to demonstrate, it's not about the diagonals, it's not about the pattern. It's about identifying areas in which you expect there to be liquidity pooling, and making sure those have been tested, and you think they've been at least largely consumed or eroded before you start longing this. Similar kind of thing on on Bitcoin last year. I remember everyone had this structure marked out. Okay. But this isn't compression, and as a pattern, it's meaningless, because there is quite clearly fresh, untested liquidity up in there. Okay, so that's not compression. There are multiple areas in here at which I would expect there to be liquidity. So when marking out areas of compression, you need to make sure you're not ignoring untested levels. What you want is for each of these pockets to have already been consumed when you get in trade. Is that clear enough? Similar kind of structure here again, but you know, multiple points at which there is liquidity, and as a result, price finds resistance there. Should I just go through a few more examples so that it's totally clear what I'm looking for? Alex is asking, with so many untested pockets here on the way down, how do you select which one to take a trade from? You can trade all of them. Is there not a concern that because there is liquidity above, that you may be entering too early? Are you talking about shorting these untested levels? Yeah. And which one do you choose? And the worry is, you know, if you short one of these, you might be getting too early. Yeah, in this case, okay, at this point, price is bullish, okay? So for me, the higher probability trades, the better value trades would be to wait for breaks in market structure, and then oh, you meant earlier than that. So, I mean, are you saying how do you know to short there when there is still untested liquidity up there and price might run up there? Yeah. Well, you don't know how far price is going to go, but if there's a fresh level like this, and you like the way price approaches the level, then I would be trading all of those levels and seeing if you can run price down. Okay, not to say that price might not run up here to this liquidity, but yeah, I'd probably have my stop up there, or I'd wait for some low time frame market structure in here before trading and keep my stop above there. But the point is, you know, our job is not to predict where price is going to go. It's to identify good levels, wait for the kind of price action we want to see when price is coming into the level or when it's at the level, then to take the trade without hesitation and to manage risk. Okay, so I guess you never really know when it's too early, but you can have a good degree of confidence that you're going to be getting into a manageable trade if you've got a solid level like that, and the approach is you know, what you want to see, either an illiquid move or compression. Yeah, too concerned that it will rip higher to a higher pocket. I mean, I think hopefully a large part of that can be solved by a good understanding of what we're talking about today, how to identify what a good approach looks like. But yeah, to be honest, it also sounds like a mindset thing, and that's something we can work on together as well. Okay, let's get on with it. I've just got a couple of examples of compression here, so it's totally clear what I'm looking for. This is a really nice example on gold. This is your flag structure. Okay, this is the flag limit. Flag limit, which is kind of supporting the structure here. So you might think of this whole consolidation as kind of feeding off the residual liquidity in here. Okay, so I'll just track it here. Let's say you had some buyers here. Some of those buyers move up to this level. Okay, that gets tested there. That gets tested there. Tested multiple times. That gets tested there. As price runs up, you can see that it dips back into these levels. Okay, that gets tested there. That gets tested there. That gets tested there. Okay, so you can see that over the course of this range, the liquidity down at these lows gets totally consumed, and so at this point, you've got fresh liquidity up in here. You see that price never came back and tested that level. But where is the next available liquidity below price? Well, it's all the way down in here. That's why you get such a sharp sell-off when price breaks down through this low. So again, what we're looking for, the presence of liquidity combined with the absence of liquidity. In this case, it's not a gap, but it comes in the form of compression or the consumption of buy-side liquidity here. Because that's when you get volatility, that's when you get that high momentum move. This is Euro USD again, this time on the H4, I think. Another nice example of compression here. Okay, I don't need to mark out the retest there. You can probably all see that. And there are two ways you can trade this. One is to enter at the level. Okay, so where is their buy side liquidity? Down in here. Okay, never actually comes back and tests that level, but one method of entry is to note the compression and then enter at the level. Okay, at a level where you expect there to be liquidity. The idea being that sellers in here are relatively weak now, and you've got fresh buyers coming down here. You can also wait for price to break into the compression before getting in on a pullback. Okay, so you note the series of lower highs and lower lows here, and then when price breaks that, okay, the other way you can get in here is just to get in on a pullback there. So wait for that break in market structure, and then you can jump in. So I think this is gold again. It's on the M15, and this example is quite kind of instructive. I think I won't bother marking out the compression. It should be quite clear here. But the first point I want to make is that it is often a good idea to wait for that break in market structure I just mentioned. Excuse me. The prices start moving into this compressed area, to start breaking lows, in other words, before you get in, because compression can often go on for longer than you might anticipate. So here, for example, price compresses up into the level, but it just results in a pop here, a pop through that level. That being said, when price comes down and tests this flag limit, okay, that's your flag structure, that's the flag limit. Once, twice, and then moves up like this. So on the lower time frames, okay, all of this is compressed, okay. Then this pocket of liquidity up in here starts looking very attractive for a short, because you've got compression here. That flag limit has been totally consumed. In the lower time frames, that's totally compressed. Okay, so you have room for price to run, and you've got a fresh pocket of liquidity up in here. And indeed, you know, price breaks down from there quite rapidly. But you know, also just note, even though it sells off here, just note where it pauses as it moves down, because there are a couple of areas in here which weren't actually tested. So here, for example, see price never came back and tested that. There's still some residual liquidity there. See price finds support for a brief time. The top side of this area was tested, but likely there's still some liquidity down in here. Okay, and down at the low here, that was never tested. So as a result of these areas, price does stall on the way down. So it's always important just to be aware of those areas, because they are what are going to stand in the way of you and your target. Okay. And finally, this is Euro JPY on M15. This was a really nice trade I took a few months back, based on a combination of factors. The first being this kind of false break of the lows there, fake out below those lows, which I'll cover in the webinar on false breaks in a few weeks. Also note the illiquid move down, which gets quickly reversed. Anyway, I didn't take the trade down here. What I want you to pay attention to is this area up in here, okay, which you can see is almost entirely compressed and therefore really weak. So there's a little nugget of liquidity down at the bottom here, okay. The area from which price broke out of this with momentum, okay, that never really got tested, and so that's why price stalls there. And that's what I'm wanting to see consumed before I get in here. As far as I can remember, I waited for the price to consume that level and break through it, and then I got in on a pullback to this fresh liquidity, knowing that price is very likely going to run quite quickly through this whole area, through this gap to the next area of liquidity up in here. Okay. So quite a simple trade based entirely on just assessing where there is liquidity and where there is not liquidity. Okay, there is liquidity in there. There is not liquidity in there or in there, and so a nice example of price having room to run. Anyway, I think that's all for today. I hope this has given you a good idea of the kind of price action I'm looking for on approach. as well as when to expect volatility. And what I'm hoping is that as you come to kind of understand and internalize the dynamics I've been talking about over the past few weeks, you'll get better and better at identifying different trading environments, different states of liquidity, and that you'll start picking up on or noticing how specific environments often lead to quite predictable outcomes. So, as I said last week, I think it's so important that you develop a kind of roster or catalog of experiences, a relationship with price based on your own observations, and that way, when it comes to actually pulling the trigger, you're unlikely to be overcome with fear or doubt, because you'll have seen, X or Y scenario play out hundreds or thousands of times. So you'll have a good idea of what the likely outcome is of any given scenario, and hopefully you'll develop trust in that probability. Okay, so through engaging with price, my hope is that you'll come to know when to expect volatility, like in this example here, and when exactly that shift should occur, so that once you've identified a level, you're able, and you'll also have the confidence to take trades at the level and without having to think twice about pulling the trigger. Okay. And of course, the market's, it's constantly shifting and evolving. It's dynamic, and sometimes price action just won't be clear to you. That's just something you need to accept. So you should be waiting until you see exactly what you want to see in the area you want to see it, and then when the conditions are right, when you see exactly what you're looking for at the area or the level you want to see it, you'll be ready to execute without fear or hesitation. Because you know what you're looking for. Basically, you know what kind of price action you want to see to increase the probabilities of your trade working out. All good? Anyone got any questions before we finish up? If not, I think the plan is for next week. I think Friday or maybe Monday, I'll be doing a kind of a trade review. So it would be great if you could send me screenshots of trades you've taken recently. 2 or 3 would be good, or even trade plans or ideas if you're not actively trading, just marked up with your entry, stop, target, etc. Thoughts on the trade, perhaps your reasoning behind the trade or trades, and then what I want to do is just go over them together as a group, and give you my thoughts on those. Okay. And that way we can start addressing some of the more common mistakes and get into some of the details or aspects of trading which I maybe haven't thought to include or cover in webinars so far. So yeah, if you could send me those sometime this week, that would be great. The more the better, really. So we've got lots to cover. Okay, guys, so that's all for today. So thanks for your time. Hope you all have a good weekend.